When markets crash, most people panic. They sell, they freeze, they lose. But every major economic collapse in history has created a new wave of millionaires. The difference? One group sees disaster, the other sees opportunity. Today, we're breaking down the 4 worst economic crashes in history and how smart investors use them to get rich. Welcome to Like Casso, where we turn fear into fortune. 1. The Great Depression, 1929. When the market collapsed in 1929, fear took over the world. Stocks crashed, banks failed, unemployment exploded. But while most people ran from the market, a few started buying quality companies at historic discounts. Those who accumulated assets during the crash saw enormous gains in the following decades. Lesson: the biggest wealth transfers happen when assets are undervalued and fear is highest. 2. The oil crisis and stagflation, 1970s. High inflation, energy shortages, economic stagnation. It looked like the end of growth. But investors who positioned themselves in energy commodities, real assets, protected and multiplied their wealth. Lesson: when inflation rises, cash loses value, assets win. 3. The dot-com crash, 2000. Technology stocks exploded in the late 1990s. Then came the collapse. Trillions vanished. But here's what most people forget. The internet didn't disappear. Investors who bought strong tech companies after the crash saw life-changing returns over the next 20 years. Lesson: crashes destroy hype, but they strengthen real innovation. 4. The 2008 financial crisis. Housing collapsed, banks failed, markets dropped over 50%. Panic was everywhere. But those who bought real estate, index funds, strong businesses at discounted prices built massive wealth during the recovery. The bull market that followed lasted more than a decade. Lesson: the recovery always rewards the patient. The pattern behind every crash. Every crash follows the same cycle: euphoria, overvaluation, collapse, fear, recovery, expansion. The rich don't try to predict the exact bottom. They prepare capital. They control emotions. They buy when others hesitate. The real key to getting rich during crashes. It's not about timing perfectly. It's about liquidity, long-term thinking, emotional discipline, buying quality assets. Economic crashes don't destroy wealth. They transfer it from the impatient to the prepared. Every major crash in history created fear, and every major crash created opportunity. The question is simple. When the next downturn comes, will you panic or position? Subscribe to Like Casso for more strategies on wealth, mindset, and financial power. Because the market doesn't reward emotion, it rewards strategy. Economic crashes terrify most people, but they also create life-changing wealth for those who understand the pattern. In this video, we break down the 4 worst economic crashes in history and reveal how smart investors use them to build massive fortunes. You'll learn why crashes create opportunity, the psychology behind market fear, how wealth transfers during downturns, what you can do before the next crash. If you want to build wealth long-term, you must understand how markets behave during crises. Subscribe to Like Casso for more content on money, investing, and the mindset of the wealthy.